Okay, welcome back to episode 48 of the Corporate Real Estate Insider Podcast. We are back after a little holiday hiatus. I hope everyone was okay without their every other week real estate updates here. To start things off here in 2025, we have a predictions episode. We want to start by talking about the office market, and then we'll talk about the industrial market later on in this episode. To kick us off, Owen, let's hear what some of your predictions are for the year.
So with the office market, I'm going to predict that there's going to be some serious challenges as we saw in 2024, but also some opportunities for tenants and the landlords and their investors. So let me kind of summarize what I think is going to happen, and then love to hear your guys' thoughts on my thoughts. So number one, let's talk about vacancy. I think we're going to continue to see increased vacancy in certain markets. I think that's inevitable. And what I mean by that is it's going to climb higher, especially in downtown cores. And if you ask me why, the answer is pretty simple. It's number one, it's like hybrid work has, over the past few years, decentralized the workforce, making it hard to get people back into the office. Now, there will be some companies like Amazon, which as of today are back in full force. But let's see if that happens with others, if others follow. Maybe they won't. I don't think they will. To the enormity that it would take to recover downtowns. With that being said, I think suburbia might actually perform better than the downtown cores this year. Those locations that offer, high quality buildings, but outside the downtown core could see, I wouldn't go so far as to say a surge, but a recovery that unlike what you would see downtown. And the reason why is they are offering companies offices and proximity closer to where people live, and the commute times may be reduced versus having to come into downtown. So that will be a factor.
Oh, hey, Owen, let me stop you there on this whole downtown versus suburban. So obviously, one of the major trends we saw in 2024 was this kind of death spiral of certain cities. Definitely kind of urban challenges, even in urban areas that have performed better, and suburban areas outperforming because of those reasons you mentioned. Do you think that trend actually continues in 2025, or do you think that we've more stabilized? I mean, I could almost see if you're talking purely about what are trends in 2025, I could maybe see an argument that you'll actually see stronger performance in cities or in more urban areas than suburban areas, just because urban areas almost can't get any worse in certain cities. Like you think about Seattle and Bellevue, it's like, think about how well Bellevue did in 2024 comparatively. If you're thinking of like a reversion to the mean and you're way here, like maybe like comparatively downtown Seattle does better than they did last year. I mean, still, I think, it's not like rents are going to reverse or something, but I'm curious how you think about that.
Yeah, it's a great segue to what was going to be my next comment, which is that, for downtowns, including downtown Seattle, there will be a massive flight to quality. So where there will be a reversion to the mean is for those buildings that we would consider to be premium, Class A, Class A plus properties that are modern. They offer security, they're amenity rich, they've got, lots of opportunities for collaboration, they have on-site retail. These spaces and buildings could actually, in my prediction, see rent growth as vacancy falls precipitously versus where it has been over the past few years. Now, it might perform better in certain markets across the country as cities still kind of recover from what happened during the pandemic. But I could see this, I could see rent growth in those buildings now, whereas Class B buildings, which is a completely different world, will face even higher vacancies because there will be a vacation of those buildings for those seeking that higher quality. And it will be the survival of the fittest, where quality this year will remain king. So Tucker, I would say that yes, downtown offers more than suburbia, but only when the only buildings that will attract that demand are the Class A buildings. I want to be careful too with, like, we talk about the office market recovery. That's going to be different across the country, depending on what market you're talking about. Cities like Austin and Miami, with favorable tax climates and still what seems to be strong population growth, will outperform other cities such as Seattle, for example, or San Francisco, maybe even New York and Chicago. all those cities that I mentioned are still battling high vacancy rates, where Class B spaces, if you segment the market, are still in excess of a third of the market, over 30% vacant. So again, I will continue to say that quality buildings will perform well in 2025, but those cities that have an abundance of Class B properties will continue to see quite a bit amount of headwind facing this recovery that we're in.
Can I just jump in there? I think you're hitting some great points, and don't want to forget what they are. Welcome back. Thanks everybody for listening. I think every time we start a podcast this year, we should begin our podcast. Tucker, I love your intros, but with taps. I think we should just play taps for all of these buildings that, in my mind, are dying. They're just going to be dead. They're not going to be a part of the inventory anymore. We're not going to talk about them. Brokers aren't going to be able to leverage them because companies don't want to be in. I want to say in some markets, it could be 50% of the inventory, but it's more like probably 25% of inventory. There's going to be a flight to quality in such a massive way that there's going to be buildings that can't be converted. They're just going to be pulled out of the active inventory by the brokers in those respective markets. And they're just not going to be shown because every client that I'm talking to currently that can actually make a move and improve their space, or companies that are planning and building a strategy around making a move to improve their space, are talking about increasing the quality. If they're in a Class B building, they want a better Class B building. And sometimes those Class B buildings are really A- buildings, but they want to be in better space. If you're in a Class A building, you want to be in new construction. That's why we're seeing new construction rents, I think in 2025, will go up. And they'll go up in a big way. There's going to be competition for space because the pipeline for new construction is completely dead across the country, is gone. There is no pipeline for new office construction other than stuff that's built to suit. So there's going to be a massive demand issue, supply issue for this pipeline of demand that's going to want new construction. A proof point is New York, which obviously New York is a huge real estate market. There's 2.6 million square feet of new construction under construction right now of office, and 80% of it's pre-leased, right? So you're seeing similar thing in Boston where there's two buildings. One of them's been delivered. The other one's under construction. There's been strong leasing in those buildings. Unfortunately, the low-rise space in those assets, particularly one that's built by Millennium, the low-rise is very challenged space. So the building's 800,000 feet. The premium space, the 400,000 square feet at the top of the building, is effectively all leased. The lower rise of the building is sitting vacant because it's not premium space. It could be a new building, but it's not premium space. But then the second building, which is, I think 12 to 18 months away from delivery, is already pre-leasing. And it's pre-leasing in a location. It's sitting above our transportation hub. Boston's transportation hub isn't like New York. It's not a premium place to be. It's actually a kind of a tertiary location within the downtown. And it's a challenged site, but it's already leasing. And there's, in my opinion, they'll do well with their pre-leasing and leasing once the building begins to deliver. So I think this whole conversation of the winners and losers, I think there's going to be a huge segment of the market that just goes away. And if it either goes away actually or it goes away within the brokerage community and is not part of the inventory that clients are wanting to tour or even look at.
Brian, do you think that there are any other winners besides like ultra premium Class A plus office space, or is everyone screwed?
No, I think that there's some really, really cool conversions, big industrial buildings that are being converted to office, urban infill stuff that's has all the amenities. So there's particular projects I'm thinking of right now. Where was I? I was in Austin, Texas. There's one here in Boston that are 1 million square foot former industrial buildings. I think one of them was the Sears and Roebuck's building, distribution building, and it just has massive amounts of amenities. It's got this probably 50,000 foot rooftop. It's got restaurants, it's got bars, all within an office complex. So they're able to bring all of these amenities to the buildings. Those transformative projects that are city blocks, think of Chelsea Piers in New York City, like those types of transformative projects are still going to do well. It takes huge capital. It takes long conversion and construction timelines. There's not a lot of those happening, and the ones that are just doing doing site work, doing some demolition. I don't see them going in a big way. There's one here, Hilco's doing an old conversion of power plant. They've started doing the work. This is a transformative project that'll connect kind of our South Boston neighborhood to the seaport, which are two, one is like the hottest residential market. One of them is the hottest office market and life science, frankly. The project is massive, and it's one where they're doing demo, they're doing some work, but it's not something I think that they go full steam ahead on until they get some pre-leasing. So I think that product type is really, really cool if you can spend the capital and do it right.
It's also very risky, though, right? And that's why I don't think we're seeing a massive amount of delivery within this category. I mean, when I think of ultra premium office space, within that I would include sort of a subsection of like ultra premium creative office space and these adaptive reuse conversions that are generally really attractive to technology companies. The big challenge with this right now is that so many of these large scale speculative creative office developments have been put on hold, or they're being marketed as like a build to suit, or, hey, we've done some work, but we're not going to spend all the capital until we have a lease signed. And often the time from signing a lease to the time of actual occupancy is 18 months or 2 years or 2 or 3 years. I mean, it's a long time. And the nature of these technology companies, unless you're like, one of the, FANG companies or one of the, top, 10, 20 technology companies, is very rarely are they actually able to make decisions 2 or 3 years in advance. So you're sitting there where this like, okay, cool. Hey, if we could wait until 2028, there's a ton of really cool options that would work great for you, but no one can wait that long. And you think of the interest rate environment, you think of the macro risks around, hey, it looks like 2025 is going to be great for return to office based on what all these companies are doing. But what if that doesn't stick? So what you've seen happen is this whole market of speculative creative office development for large technology companies has been way underbuilt compared to what it was in, like, say, even 2020 and 2021, when there was, even though we were in COVID, there was crazy venture capital dollars being spent, and these people a lot of them were still leasing offices. So I don't know. It's interesting in that, like, yeah, that space may do well, but it's very binary. You deliver 200,000 feet of creative office space, and either Meta or Nvidia or whoever comes along and leases it, and you do incredibly well, or it might sit vacant for 3 years and you're kind of screwed. So I mean, it makes sense why you're not seeing that many people deliver that kind of product right now.
Yeah. Plus the lending markets are not in a position to support it, right? So even if I'd love to see one of the, Blackstone or somebody raise a fund and start deploying capital in this space, because I do think it could be a very lucrative market to be in the next 24 to 36 months. Problem is they can't finance it with any debt, and it's just a very hard asset class. When money's in, it flows, and to the point where it flows kind of stupid. Like they're buying up buildings, they're trading things that are really that make sense on paper based on fictitious rent growth, and the capital's flowing hard. And then now, even when things start to make sense, and you see a real need in these markets for this creative office or a new office, there's just no capital flowing into the space right now. It's either on or off, unfortunately.
Agree, guys. Those are good comments, really. I like this discussion. I hope our listeners do as well. Let me round out my predictions, and then I imagine you'll have other comments to add. 3 more for the office market. Let's talk about hybrid work for a second. Hybrid work is here to stay for 2025. You'll keep hearing headlines about companies calling workers back to work. Some on a regular schedule, like 5 days a week, others maybe 3 or 4. But for many businesses, hybrid will remain some kind of a model for 2025. I'm not suggesting companies will be full remote, but you will see some sort of hybrid schedule implemented across the board for most companies, is my prediction. So that's kind of, I think people are going to wonder where our heads at with hybrid work, and that's my thought.
Do you want my thought on that right there, Owen?
Yeah, fire away.
I think hybrid is dead. Everything's dead to me this year. So no, I think hybrid's dead. It's gone. It's and hear me out. Hybrid is the new full time in the office, right? I think 2 days a week is not hybrid. 2 days a week is going to be is something of the past. But 3 to 4 days a week is the new 4 to 5 days a week. And before COVID and before this transition to remote work, a lot of companies were sitting between 70 and 80% occupancy on average, right? So it was never 100. 90 was really high. And within the US, 78% was kind of full time in the office. Well, I think now it's probably 60 to 70. And that's full time in the office. And it's not hybrid, it's full time in the office. And people have the flexibility to work wherever they want, when they want. And I don't think it's going to be defined as stringently as it has been, where it's like you're in the office Tuesday, Wednesday, Thursday, you're at home Monday, Friday. It's going to be like, we expect you to be in the office, a certain amount of hours a week, and you can kind of make your own schedule and just be there when you need to be there. And it becomes ingrained into the culture rather than it being this something that people are fighting to. I don't want to work 3 days a week in the office. I want to work 2 days. I don't want to work in the office at all. It's just, it's here to stay. It's part of what the expectations are of employers. I mean, I think a survey you sent around, a few weeks ago, the KPMG survey with 1,300 CEOs are polled every year, I believe, by KPMG. I think it's every year, it might be twice a year. But 83% of those CEOs predict full return to office within 3 years. But I think what's lost in that is full return to office is not 5 days a week, and it never has been for most knowledge workers.
Yep. I couldn't agree more. Well, it seems like we're pretty aligned there. Let's talk about two more. Venture capital. It's a huge one because venture capital investments usually spur a lot of demand, which can help recover office markets. So I will predict that venture capital does not hit the highs of pre-2022. But I think there's reasons to be optimistic here. They being the VCs, are sitting on hordes of cash. And I believe they're going to start deploying more capital this year. Again, not to pre-22 levels, but you're going to see more. And I think it's going to be limited to high growth areas. And what I consider high growth this year are going to be AI, cybersecurity, SaaS, and life science, particularly with drug development. And that's where the money will flow. Now, will that generate more demand for office space? I think so for those companies. Is it going to entirely change the market? No, but that's one to watch because that could have a big impact on demand recovery for those markets that have workforces that can support those industries. And then finally, let's just talk about the opportunities, and then I might give you my prediction for a surprise.
Hey, Owen, before we go there, can we talk a little bit more about venture capital?
Yeah, let's do it.
Specifically, what areas of venture capital do you think are going to do well? Because if you're sitting there thinking like, okay, look at some of the markets that are performing worst across the country, right? Granted, people are always reading articles around how well Manhattan's doing, which, by the way, I think the consensus amongst this group is that Manhattan is not actually doing anywhere near as well as advertised. It's a bunch of sort of optimistic headlines. But when you look at markets that are objectively doing very poorly, and you look at like a San Francisco and markets like that, I think if you can sort of narrow in on what sectors of venture capital are going to have the most money spent in them, that allows you to sort of say, okay, the Class A plus like high-rise office building, which I don't think is very often attracting the venture capital companies at the same frequency that the adaptive reuse creative office projects are. I mean, like where is the money being spent, right? Like where are these people going to be investing their money, and how is that going to have it? Like what segments of the office market or sort of flex market or industrial market is that going to have the most direct impact on?
Yeah, I think for downtowns, I think AI and machine learning, could be beneficial to downtown office markets, because I typically see those companies in downtown high rises as well as fintech. So I think those could create downtown office jobs. Where I think it could be decentralized from downtowns is think about space. Like I think there's going to be a lot of spending in satellite technology, space exploration, even space data analytics. I mean, think of all the technology that goes into launching things up into outer orbit, or just simply into orbit. Tremendous amount of work. And those might be downtown office jobs. But like the space tech, I mean, we typically see those companies have uses that don't typically end up in downtown. They end up in suburban markets or even somewhat industrial markets, depending on what they're doing. And then, for companies that are doing robotics and automation, those could certainly not be in downtown cores. I mean, think of the automation that's going into warehousing, and that's one of the things we'll talk about when we get to industrial. I mean, just with the forklifts create a tremendous amount of injuries in the industrial workplace every single year, and more companies I think are going to move towards logistics and supply chain automations in their warehousing. And there's a lot of companies around that are making changes, and I don't think you're going to see those companies in downtown markets either.
Something that's so interesting to me is that, John, I know you want to talk a little bit about all the life science carnage that's happened, but another sector of the real estate space market that is performing better than most is hardware technology requirements, right? And you think of most of these companies have really heavy software components and also have hardware components. You think of like a SpaceX type of company, right? There's going to be people that are working on all the software. There's going to be people building the actual rocket. And a lot of times there's a massive amount of collaboration between people working on software and people working on hardware. And their facilities usually reflect that. I mean, typically they have components of their R&D facilities that have really high-end creative office space. And then they have all kinds of, machining areas and, clean rooms for electronics. And they might be doing, indoor engine testing. Like all these companies have all different kinds of needs, but they're very specialized. And there's a lot of similarities to life sciences. And I predict that in 2025, we will start seeing some of the people that went really deep into life sciences and built a specialization around a lot of the really intense requirements that these companies have sort of transition and say, hey, we've already cultivated this set of skills. Let's use this set of skills to go after this market that is really underaddressed. And it's not as if the hardware technology market is as big as the life science market whatsoever. I mean, it's a fraction of the size. But right now in Los Angeles, which is one of the highest concentration areas of these companies, there's basically no options where if you need 50 to 100,000 square feet and you need half of it to be office and half of it to be industrial, there's literally zero options that work well for you. And you have to go out and lease an industrial building and then build a bunch of office space, which is incredibly expensive. And unfortunately, usually takes like a year to do. Sometimes longer, depending on, where it is and what you're building and all that. So I think that's an area where someone with pretty low risk could speculatively build these things, charge premium rents, and get people to do that. I mean, very similar to the, Alexandria and, Biomed market and life sciences, what they've done for that market, someone needs to do and come in and make a play to do that in the really core hardware technology markets like, Los Angeles, Boston, Austin, Dallas, Seattle, where there's a very high concentration of these companies that are currently underserved.
It's such an interesting perspective, Tucker, because active right now with one of these types of requirements on the peninsula and outside of San Francisco, and it's 75 to 150,000 feet. There's probably 40 options that provide you with. Now, all of them don't have the power that you need for some of these requirements. So if you need excess power, there's a lot less. But if you are, if it's a standard industrial power need, there's so many options. And, there's a lot of owners that are rumored to be losing their buildings to the banks. There's buildings that have been vacant for 4 to 5 years where they've gone in and done market ready office, improvements to try to attract these types of companies, and they're just sitting there vacant, and there's just not enough demand in the marketplace. The ones that have, if it's got 10 megawatts or more power, somebody came along, if it's Tesla or if it's NVIDIA or someone came along, just leased it because it has that power sitting at the site. But it's so interesting to hear down in LA that product type doesn't exist, where there's so much of it, sitting a couple hours north on an airplane.
Yeah, this is a Silicon Valley phenomenon. There's such a large quantity of this sort of hybrid office industrial space in the Bay Area that's currently available, and that market just doesn't exist in very few markets around the entire country. I mean, I know from working on, collaborating with Owen on projects in, the Pacific Northwest, super supply constrained. It's incredibly supply constrained in Southern California. I mean, not to say that there aren't options, right? But if you are looking for 100,000 feet or 50,000 feet or 150,000 feet, depending on when you're out in the market, there may truly be zero options that actually meet all of your needs. And then you're having to sit there and, as Brian, to your point, say, hey, this building's great, but doesn't have the power we need. And it's going to take us a year to get a power upgrade in Southern California. It's very complicated. No one has sort of removed the friction. And this is sort of reminiscent of the kind of immature life science market, where you're representing a life science company and you say, okay, here are all of our MEP needs. None of these buildings work. Which building is closest to working and therefore going to be the least expensive to invest in building this infrastructure? And then let's select the least bad option out of a set of options where none are good. And that's sort of what's happening in Los Angeles for hardware technology companies right now, unless you get very lucky. I think there's an opportunity for somebody to come in and change that and really do well.
Yeah, that's interesting. That is the life science play, right? Because you need to be, historically it's been 9 months. You need to be 9 months from operational to attract a life science company, just based upon the way that they get funded and the way that they need to progress their drug discovery, right? So if you are trying to package these improvements as future improvements that you're willing to make, you have a very difficult time attracting the tenants. That's why there's so much spec life science space coming to market that, in my mind, it's in Boston, some of the tertiary stuff that's brand new life science space coming to market, it may never lease as life science space. They took a flyer on the demand that was in the market over COVID that historically wasn't there before COVID and isn't there after COVID, and I don't think will ever come back. That you've got to come out of the ground, you've got to get going, and you need to be within 9 months of an operational building for them to do a lease, and it takes big capital. Even with these tough tech hardware companies, we're seeing it here where, a lot of times they would rather take a building that's extremely low cost, bring in a developer to work with you to do the hardware side of it, put the office people in a lower cost office building, right? A single story office component, work with you to bring whatever improvements you need to bring to it, but bring half the building up to speed faster, get operational, and try to do the work around you with a development partner, rather than wait until the entire building's ready for you all at once, right? So people try to get creative. It makes it more expensive. It makes it more difficult. But there's the needs there, and the buildings don't exist. So what do you do?
I'll chime in with one idea for investment, whether it's 2025 or 26 or 27, but into the future that nobody's mentioned yet. I think it's energy. Energy is such a significant part of our future now with AI and compute and these data centers, and watch for interesting investments into the energy space, whether it's extraction or innovation. Energy is the future. In the 60s, it was plastics. I say today, energy is the future. Watch for investments in that space. And if you're ready for it, I'd love to pivot into life science. You've alluded to it there. And I wanted to tell one story in particular, which I think really highlights what's happening, why it's important. There are a bunch of examples of this, but in South San Francisco, and in particular for public REITs. It's interesting to note how many of the life science REITs aren't public, right? BMR, owned by Blackstone. You can't really find out what they're doing. But here's an example where Genesis, South San Francisco, phase 3, they had Bain Capital as a partner. They bought these office buildings, converted them to life science, got them leased up, and sold them off. Great timing. October 15th, 2020, sold them for $1 billion, about $1,275 a square foot. 1 Tower Place, 2 Tower Place, or the third building, 4,000 Shoreline Court. The acquirer was Ventus, a public REIT that invests in life science. They also do medical and other spaces. They paid a 5 cap, and it was 96% leased. That's what these companies buy. Except if you fast forward to today, okay, so 1 Tower Place now has available floors 7, 8, 9, 10, 11, and 12. 162,000 feet available, 48% available. 2 Tower Place now has available 5, 6, 10, 11, 12, 19, and 20. 137,000 feet for 36% available. The 4,000 Shoreline Court building, a 4-story building, now has 73,000 square feet, now has 46,000 feet available. That's 63% of the building that's available. Okay, so this is a problem, right? And I'm active in that market today, and we're trying to peg where our new markets today. So interesting, here's a public company. Let's listen into their earnings report. It's not discussed. And these analysts that are on the call to sort of dig into, they don't ask. Why not? I mean, this is $1 billion investment, and they may be down 40 or 50%. You would think that would be more. So look, call me naive. It only taken me this long to realize that this public company reporting isn't all it's chalked up to be. Like, when would a public company report this bad news? And I'm coming to think maybe only when they have to. And they're not being held to account now. And therefore, the market's unaware. Like, I mean, unless you're doing what we do on a daily basis and touring these buildings and seeing this vacancy. But by and large, the headlines aren't reflecting this today. So it's happening in the market today. I'm here to report it. And as I say, it's only taken me this long to realize that, CRE is a highly illiquid and opaque marketplace. And when do public companies report all this bad news? Only when they have to. And I see example after example where it's not being reported today, but it's here to report on the pod that that life science market is a problem coming.
I don't disagree. And again, I go back to my earlier comment, which is, venture capital, if it does decide to return to select investment, how much of that might play into life science, because it's so key with life science growth. I mean, companies really, less those that are like the big ones like Pfizer, and Moderna and so forth, including manufacturers. It's just these smaller companies that tend to incubate within universities and then grow out to acquire their own lab and then sometimes have unbelievable growth. That's all fueled by investment, venture capital investment, and it relies solely on it. So, John, I couldn't agree more that it's one to watch. That sector is definitely one to watch this year and is going to be depending on the amount of return on investment.
I'd be, cautiously optimistic. Obviously, sitting here in New England and Cambridge being the epicenter of life sciences, I think the key things for me are investments into the sector, but also where does this new administration fall with some of the promises that they've made around changes in the regulatory environment for big pharma, right? Because a lot of the investment does come from VCs, but the VCs invest in these companies because of an exit strategy for big pharma to buy that drug discovery by that company, really. And that's by and large a major component of investing in these drugs, is not to come to market with a drug. It's to get to the point where big pharma finds you attractive to put into their drug discovery pipeline. And if their world is getting flipped upside down, how much of their focus and capital will be in to reinvest into drug discovery, I don't know, but I think it's something to watch. And I think if you listen to people in the sector, there's still a lot of uncertainty around how it will recover. I think from a real estate perspective, it is probably worse than the office at its worst point, at least here in Boston. There's so much. I mean, it's 37% available in a market that is 50 million feet, with, 1 million to 1.5 million square feet of demand. And historically, demand has kind of sat around that 1.5 million feet. It jumped to, it depends who you ask, 6 to 8 million, 5 to 7 million during the peak COVID years. But it's kind of reverted back to the mean of 1.5 million. And when you have, almost 40% available, and we're not talking, converted buildings. We're talking brand new IQHQ, millions of square feet. We're talking, really, really high quality, really expensive real estate that's going to be, it could get turned into a warehouse, or maybe it gets turned back into office, but it's not going to be, in this cycle, anything resembling a life science lab building, I don't believe. So it's really interesting.
Yeah, it is really interesting. And you think about the new administration and, impact on big pharma. You also think about the potential of, things like, Department of Governmental Efficiency. Like, what if the FDA can become much faster at approving new drugs? And you think about the reason that the entire life sciences sector is so interest rate dependent, right? Is because you just think about the time value of money when you have a discounted future cash flow model and you're not going to be generating any kind of real revenue for a decade, right? By the time you think of, okay, we need to get through all of our trials, we need to get FDA approval, then we need to go into kind of large scale manufacturing of, whatever, product we're bringing to market. It just takes so long to generate a lot of revenue. And if you're discounting, revenue 10 years from now at, the 2% or 3% versus 7 or 8%, it's obviously really changes the return profile of these transactions. If all of a sudden the timeline to reach meaningful revenue for a company doing drug development is cut in half, then that's going to completely change the paradigm of life science investment. And there's going to be a ton of companies that have really promising drugs that investors pass on because they just say, this is going to take too long to get approved. There's no attractive kind of risk return here on the investment. It could completely change and create this massive surge in life sciences that maybe is the only hope of wiping out the 40 million square feet of inventory in Boston. So we'll see.
It's a good point. It's certainly, there's opportunity to improve that process. That if any administration can improve on it and streamline it, I think all parties involved, including the consumers and the regulators who are the ones who have to deal with it, and obviously the companies developing these drugs, everybody would be better off. The interesting part is that what comes back. I still don't believe that. I think that the lessons learned for companies in terms of how they acquire space and how they use space is here to stay. Right? If you're a company that has 10 people, you need to start getting into the lab, and you need to have some fume hoods, and the only thing available is 10,000 feet. You take it. If the only thing available is 20,000 feet, you take it. You try to sublease half of it. I think those types of just challenging long-term decisions are something that's not going to come back. I think companies are going to be much more pragmatic about their space. I think they're going to stay in incubators longer. I think they're going to outsource some of those trials and lab work rather than try to bring it in-house. It's just, I think the market has learned a lot in terms of how they take down space that is going to really impact these tertiary markets. And let me be clear, the core market of East Cambridge is still pretty healthy in comparison. It's not back to equilibrium, but it's healthy. I mean, there's very few sites left for new buildings. You've got just last week or 2 weeks ago, Biogen. I'm sure many of our listeners have heard of Biogen, major drug company. They just announced, or are rumored to be announcing, their new headquarters, which is being built right in East Cambridge at a site that MIT got control of for 500,000 feet, right? So that'll be a massive project that gets announced likely in the near future if what we're hearing is true. And there's just not a lot of that type of product. You move 2 miles as the crow flies to West Cambridge, and there's millions of square feet that are either in development or coming online in a number of projects. So, and that'll probably never get leased. And that could be your story, John, in South San Francisco. It could just be the wrong location for the product. And location out of anything right now is like there's a herd effect of life science companies. They want to be in these clusters that if you're not there, then you're in a real world of hurt. The secondary, tertiary markets are not coming back the same way.
What's going to be super interesting to see play out is that so many of the vacant buildings are these brand new, shiny, beautiful projects, and they're going to have to compete. And we'll see where price discovery ends up delivering those rental rates. But then what about the second generation older lab buildings? I mean, they have to be a discount to the shiny new buildings. So where do those end up on pricing? It's going to be really interesting to see that play out. Just help me with my math in Boston, Brian. So you got a 50 million square foot market that's 30% available. That's 15 million square feet, an average annual net absorption of 1.5. So that's a 10-year supply.
Yeah, that's the quick math. There you go.
Brutal.
And the largest tenant in the market is going to build a building that, they're going to the Volpe site, which is the old transportation site that isn't in that inventory. And they're coming out of more than 500,000 feet, if it was off the top of my head, of second generation space within the marketplace that they're leasing or own. I think they own some of it as well, that they'll move out of. So it'll have a negative effect on absorption.
Add that to the denominator. Brutal.
Exactly. Brutal. It's brutal. But what we are seeing here, for those, to your point, on the tertiary markets, rents are getting to the point. Well, two things. One is owners that have it at a basis and probably haven't fully invested in the base building package to support life science in these tertiary markets, that have single story buildings that are going to be conversion candidates, that we're getting to the point where our tough tech rents, if the owners have a basis and they haven't fully invested in the base building for life science, and you've got tenants that have a need, those two markets are coming together. And there's stories of really win-win situations where owners have buildings that they had slated for conversion to life sciences that can reach and do a tough tech deal, right? For this new types of, whatever it is, clean tech, tough tech type space. And you've got tenants that are now realizing that location, employee satisfaction, attract and retain talent, all of those are better to be in the right location than it is to go and chase pricing further away. And you're bringing those parties together, and there's some deals happening. And we're looking at a number of those deals in the marketplace today that could be really attractive to all parties. It wouldn't create the returns that these owners would have if they were successful in converting to life sciences, but it's kind of getting them out of, it's throwing them a lifeline to get them from sinking as they tread water.
Love that discussion. Let's talk about, I want to wrap up office, and I want to give some time for industrial for our listeners who are curious. But if you guys have any surprises, so predict any surprises that you may see or that may come to fruition in 2025 for office. And I'll start with mine. And then we can use this to wrap up and then move into industrial. So the surprise that I predict could happen in 2025 is a tech-led recovery. What if tech has a surprise comeback? And all of a sudden, those tech companies follow the path that Salesforce and Amazon and others are leading to bring people back. Even if it's not 5 days a week, coming in 3 or 4 days a week is going to demand a lot more office space than when you're fully remote or only 1 day a week. So a hiring surge based on an innovation wave with investments and venture capital. Think AI, quantum computing. All that could create a tremendous amount of demand for markets like Seattle, the Bay Area, even Austin, Texas. So it's a long shot because Seattle and the Bay Area have a very long way to go to get back to a point of equilibrium, what I would consider to be healthy vacancy. But it's not impossible. So that could be a big surprise that the markets that have a lot of tech-based employees or a strong labor force could see some sort of recovery. But that would be my 2025 surprise for office space. Anyone else want to chime in with a surprise they have?
I do have a surprise. It's unfortunately it's a little bit more negative than yours, Owen. The default rate on commercial mortgage-backed securities just hit 11%. Just to give you context, in the great financial crisis, it was at 10.7%. Equilibrium, kind of normal, is, it's been 1-2%. I think the Crexi folks track it back to 2000. It's been a point to 2 points for many, many years. Obviously spiked in the great financial crisis, and we just surpassed it. And this is just for office. This is predictions of the office space. I see that going over 15% before the end of the year. I think that there's massive amounts of office space that's going to get turned back to lenders. These types of lenders with this commercial mortgage-backed securities are very unflexible in terms of their ability to do workouts and their ability to work with owners. So as those loans expire, we're going to see a massive increase in the amount of loans that get taken back by special servicers.
You guys want to move on to industrial? Let's talk about trends for 2025. And I'll start with kind of nationwide look, and then we can dial into your respective markets. So I think we're going to see demand stay strong, driven largely by e-commerce and 3PLs, third-party logistics. And as to Tucker's earlier comment and discussion with Brian, manufacturing, because some of that will require industrial type space. So even with some of you are experiencing or seeing new construction in your market, I think vacancy will stay historically low. And you might see some modest rent growth. So it might be slower, but it will remain positive. I don't think we're going to see rent actually fall. And then the other thing I think we'll see is that you'll see even more focus on last mile logistics. You'll see facilities pop up close to urban centers with companies doubling down on faster delivery capabilities, which we all want. To compete with this, what has become like an on-demand economy. I mean, everyone wants to, use their phone to buy some new light bulbs, and they want them that afternoon or tomorrow. I think you're going to see more and more of that throughout the nation.
Can we go back to this, steady demand and, rents not falling and all that? Look, rents fell a very significant amount in the second half of 2024. Sort of on a national basis. It certainly did in Southern California and the majority of large industrial markets around the country. I'm sure there's examples where rents, increased or remained stable in certain, random submarkets that are supply constrained around the country. But 2024, like the second half of the year, was a terrible year for industrial real estate. So when Owen says, hey, I think that rents are going to be flat or, more or less remain consistent, that's off of a very lackluster second half of 2024. I actually think that you're going to see industrial rates continue to fall. Maybe not dramatically, but I think that they're going to come down and not remain static. And the reason that I think that is that there is a lot of fear in the market around, what could happen with tariffs, what's going to happen with the macro economy in general. And there's just a lot of supply that's come onto the market. And I think that the market will respond to that, heightened level of supply by lowering rents and trying to meet tenants where they need to be to make their businesses work. So, maybe not like a super divergent opinion from Owen, who's, saying, hey, I think the market's going to be consistent after 2 really bad quarters where the market went down a lot. I think that there's probably a little bit more to go. And further, if you actually see interest rates come down and you see the construction cost to build industrial buildings come down, which they have been, right? Because there've been less buildings under construction and, you're just seeing costs across the board come down as a result, simple supply demand equation there. If those costs come down, then it becomes less expensive to deliver new construction buildings. And if new construction buildings are less expensive, that's going to very quickly drive down the entire market, because such a large segment of the net leasing that's happening in any given quarter is in new construction.
Tucker, great points. And thank you for bringing up what happened in the latter half of 2024. And it's also important for our listeners to understand that industrial real estate markets are highly localized in much respect, like offices as well. So national trends may show moderation, but for example, high demand areas could see an increase in rents and others could see a decline. But I think it's also important to note, as Tucker brought up, I mean, if macroeconomic conditions worsen, if tariffs, cause issues with what we bring in from other countries, or if speculative developments lead to overdevelopment, I mean, we could see pockets where rents, definitely decrease. But I think broadly speaking, the fundamentals, especially coming off our discussion about office space for the industrial real estate market, are much, much stronger heading into 2025 than the office. And I think that's a foregone conclusion. Everyone knows that. But just remember that there are a lot of nuances when you talk about real estate and understand your local market, because they can be highly localized.
I'm going to take a different approach. I think I read over the break that Mexico surpassed China as the U.S.'s number one trade partner. I don't know if it was just for the quarter or for the year, but it got me thinking and doing some research on this trend. I think that industrial real estate is going to have downward pressure. I'm with Tucker, because if this is true, if Mexico becomes our trade partner, there's going to be a much less reliance on large warehousing and storage needs for companies. It goes from weeks on container ships coming out of China to days on a truck from warehouses in Mexico or production facilities in Mexico. It massively changes the global supply chain and logistics model, where you could be on demand, at least into your large DC model. You could be on demand out of Mexico coming across the border. I think there's a real shift to try to bring things back to North America, and I think Canada too, with some industries and sectors, but Mexico more. That if we continue to see a trend out of China and into other markets in the Western Hemisphere, including Mexico, we're going to see the industrial markets here suffer, because you don't need as much product, you don't need to store stuff as long when you don't have to ship it from China on a boat for a month.
I would say that with the incoming administration, we're going to see a much more business-friendly environment, so that in the near term, I think we're going to see a little bump. How that plays out in the long term is subject to a whole bunch of factors I'm not going to go into. But in the near term, I think things are going to pick up and generally be positive, and new business formations will rise, and they all need to lease space somewhere.
You know what's something one very interesting, and this is something that was shocking to me. And Owen, you hit on it, but it was around the tariffs. And I was having a conversation with the CEO of a company before the break, and she was telling me that their clients are scrambling in a big way to respond to the prospect of tariffs in particular countries. And the clients are really putting together contingency plans to change locations for manufacturing, for R&D, if these tariffs go in place. And it's created a big business for them to help companies work through this. But we, at least in my perspective, you listen to politicians during the campaign talk about tariffs, and to a certain extent, you kind of take it with a grain of salt, because you don't know, but you understand from reading there's a lot of complexities in the markets that these create. But if you're running a business, you actually have to take that seriously, which is, to me, it's maybe some of them are serious and some of them are not. But when you paint such a broad brush, you would expect the marketplace to wait and see. But these people running businesses can't. They have to spend time, effort, and money to continuously plan against the prospect of changing cost models if there's tariffs that go in place wherever, for the right reasons or the wrong reasons. It does create this downstream effect of really having having to figure it out, which I thought was really interesting.
It has a huge impact. I mean, think about you mentioned Mexico. Think about the reshoring that we could see where companies accelerate those initiatives, leading to a rise of demand for real estate in regions where they're trying to solve for that reshoring. I mean, there's going to be a shift in global trade routes, and profit margins will affect leasing decisions. And so, to your point, regions closer to the United States, such as Mexico or Canada, could see increased industrial activity. And so, who knows? I mean, we'll see where things go. I know that it was just announced that Justin Trudeau resigned as Prime Minister of Canada, not over tariffs, but he was getting a ton of pressure, I know, from the incoming administration, who was even threatening 25% tariffs on Canada. So, I mean, whether tariffs are actually implemented or not, who knows? But it will absolutely have an impact on what happens. So a lot of uncertainty, but I think we'll know here soon where things start to head. I want to just kind of offer a surprise. We did that for office market. One surprise, which I want to caveat, may happen for the industrial market this year. Think about multi-story warehouses. I know we all have them in our respective markets. They've primarily been limited to locations very close to city centers, like New York. I've seen them in LA. We have a few here in Seattle. But one surprise could be, what if developers find creative ways to squeeze more efficiency out of areas where there's limited land for development? So, could you start seeing multi-story warehouses not within just a few miles of downtown cores? I don't know. But in areas where there's limited development capacity, is that something we start seeing in 2025? Maybe. I don't know. I was thinking about surprises that came to my mind.
It's just something I've been talking about for a while, Owen, and it's not. So the simple thing to me, having done work all over the globe for many years, the simple thing to me isn't multi-story warehousing. It's using the warehousing differently. So if you go to Europe, they park on the roofs of the warehouses. So instead of trying to build a 2-story warehouse, build a bigger warehouse and put your parking field for the employees on the roofs. I think that was probably an easier engineering accomplishment than trying to create an efficient 2-3 multi-story warehouse. So I leave you with that. It's like, why can't we be doing some of the more simple? I know there's cost to put the parking on the roof, but it's probably cheaper, or it's probably at least a little easier to figure out for the tenants that are using the warehouse to put the parking on the roof. That's the first thing I want to throw out there. The second thing is, I was in a meeting with a major developer, urban developer, about 5 years ago, and at the time they were studying with some of these autonomous vehicle partners and Amazon how to create urban warehouses within the urban core. And at the time, office was still booming, but this is accelerated now, where you take old office buildings and this is what they were studying at the time, because parking was becoming a commodity, and these underground parking fields were not being utilized. And what Amazon was trying to figure out is, can they turn these massive urban parking fields, parking garages below grade, into warehouses? Now you have office buildings sitting on top of these parking garages. So is there a way to use below grade warehouses in urban cores with an office building that you turn into the logistics of that, and be able to have all your technology and machinery below grade? No one sees it. No one feels it. It's a reuse of these existing parking fields. And it comes up into an office building, which is your, inbound, outbound, point of contact with the warehouse. So I think there's going to be a lot of really cool ideas and technology in expensive urban markets to try to figure out how to repurpose buildings. And to me, there's going to be multi-story warehousing within the urban core that someone is thinking about that we never saw coming, those were two ideas that I had.
I still vote to tear the building down and turn it into an urban parklet. That's just me.
Okay, let's wrap there. Thanks, everyone. That's episode 48, first episode of 2025. Appreciate everyone listening. We'll see how these predictions play out throughout the year. Back to you with the next episode soon. Thanks.